Hello to you all. Be welcome to this new tax talks. We are very happy to exchange with you after a few weeks during which we didn't exchange much, but we did hard work. We did work very hard to deliver these tax talks to you today. We are going to examine a number of topics. If you have questions, you have here the email address. You can send the questions and we'll address them at the end of the session. We'll probably speak during 45 minutes maximum, and then we'll have room for Q&As. The topics of the day. I'll drive you quickly through the G20. As you know, we had the G20 finance ministers meeting in Baden-Baden around 1 week ago, 10 days ago. Then we'll do an update on the inclusive framework, the membership, the current activity, the review process which has started, an update on the work on transfer pricing and the standards on transfer pricing, which are being worked out. Jeff van der Volk will mention that to you. We will then move to the multilateral instrument, the date for the signing of which is approaching. And then we'll have a focus on tax transparency, work on automatic exchange of information, the OECD blacklist for the G20 summit in July, and we'll finish with two tax policy topics. One is about tax certainty. We did deliver a report to the G20 finance ministers, and this has been reflected in the communique of the G20. Giorgia Maffini will brief you on the main findings of this report and on the follow-up. And finally, we'll talk about VAT. I know most of you are direct tax people, so are most of you on our side, but we also have Pete Batio with us, who's doing all the work on VAT, which is gaining a lot of profile and a lot of attention. So we'll spend a couple of minutes on VAT and then we'll move to the Q&A. To start with, the G20 meeting in Baden-Baden a few weeks ago, starting with the report of the Secretary General. You know that at each of the G20 meetings, the Secretary General of the OECD reports on our activity, and he usually attaches to the report a report by the Global Forum on Transparency. This was discussed by the G20 finance ministers' deputies and then by the G20 finance ministers, and you can see the outcome of their discussion reflected in the communique. We have just selected a few extracts. There are 3 paragraphs dealing with tax this time, which shows the prevalence of tax almost in the G20 discussion. And we have selected a few elements. The first one, which I think is extremely important, is the fact that the G20 recalled everybody that they are and they remain committed to the implementation of the BEPS project. And here maybe a side remark. It was the first meeting of the Secretary for Treasury of the United States, and everybody was looking forward to hearing what he would have to say on many aspects. And his first intervention at the G20, which was not during the tax session, but the first session of the G20 meeting, was to recognize the work by the G20 on tax, and in particular on BEPS, with the commitment of the United States to this project. So I think that was a very important message reflected here. Second, on transparency, you have the usual language inviting countries to implement their commitment to automatic exchange of information, to sign the Multilateral Convention on Mutual Assistance, but also this important message that they look forward to the OECD's list of uncooperative jurisdictions by the summit in 2017. The third message is about the fact that they welcome the report, they acknowledge the report on tax certainty, which was submitted to them. And there is a mandate, which I think is the most important thing, to the OECD and the IMF. The report was on tax certainty was co-produced by the OECD and the IMF. There is a mandate to both organizations to follow up and to report back to the G20 finance ministers and the G20 leaders on what countries are doing to increase certainty. And here again, a very constructive and positive discussion. The Minister of Finance of Germany putting a lot of emphasis on the need to promote tax certainty, on the need for tax administrations to pay a lot of attention to this issue, on the need for tax policy makers to incorporate that dimension when they legislate, and on the need to deliver technical assistance to developing countries for them to be better at this, because this will increase investment that they badly need. So a good, positive and constructive conversation took place as reflected in the communique. Finally, there was a long discussion, an animated discussion with most of the G20 finance ministers, highlighted their will to see further work in the area of tax and the digitization of the economy. And in spite of the task force on the digital economy, which is in the inclusive framework within the OECD, in spite of its mandate to come to an end in 2020, with a big report expected in 2020, finance ministers said it needs to speed up, and therefore we would like an interim report by the spring meetings of the IMF and the World Bank in 2018, meaning that we have 1 year time to come up with an interim report from the task force on the digital economy to explain what can be done, with the remaining most problematic issue being the tax treatment from a direct perspective of the digitization of the economy. A very positive meeting, and next one, which will be dealing with tax, will not be in April. There will be a quick meeting of the G20 in April during the spring meetings of the IMF and the World Bank, but in July, just before the leaders' summit, and the leaders will definitely have tax again on their menu. A quick update on the inclusive framework on BEPS. And as I indicated, we will go through a few things: the membership and then the activity on peer reviewing the minimum standards, the standard setting activity on transfer pricing, and the implementation of the multilateral instrument. The inclusive framework is still growing. You will remember that it was established at the request of the G20 last year. We had the first meeting in June 2016. The second meeting took place at the end of January 2017, so a couple of months ago. We had many countries attending, and almost all the members, I think we had above 85 countries attending. The number of members today is 94. 94 countries and jurisdictions have joined the inclusive framework on an equal footing, meaning that all these countries and jurisdictions have committed to implementing the BEPS package, and in particular the 4 minimum standards. And if you look at the composition, you can see that it's quite diverse and balanced between OECD and non-OECD countries. There is a majority of non-OECD countries which are members. And if you look at the diversity from a regional perspective, you can see here too that we have a good balance between European countries, African countries, and others. I think we're almost at 20 African countries which are members of the inclusive framework. You can see that we have extended the membership of the steering group to reflect the growing membership of the inclusive framework. We now have 20 members of the steering group. You can find the information on our website. But the 2 latest members to join were Egypt and Jamaica, which have joined Senegal and Nigeria as developing countries. But we have also some G20 non-OECD countries, Brazil, China, South Africa, India are there, and a number of OECD countries. We also have Georgia among the developing countries. Now we'll move, and I will turn to Hakim Pros from the team, because he's in charge of most of the minimum standards peer review. So I will turn to Harim, who will brief you on where we stand on the terms of reference, the methodologies, and the peer reviewing of the minimum standards. Harim.
Thank you, Pascal. Yes, let me take you through where we are in the activities of the inclusive framework. As it says here, the focus is on implementation, as the Secretary General says, in no particular order. So you see here the BEPS actions that are the minimum standards. Not all actions are created equal, so those are the ones where we had consensus at political level that those are minimum standards, those everybody has committed to as part of the package, and those are going to be peer reviewed. We also do a lot of work on monitoring other actions, but I'm going to focus on where we are in the implementation of the minimum standards. So the first is where are we? Every peer review requires terms of reference and the methodology. As you see with the check marks on action 5, that is agreed. On action 13, that is agreed. On action 14, that is agreed. And it's also available on our website for anybody that does want to have a look in more detail of how this process will be moving forward. Perhaps also a word on the peer review. This is not an exercise for the benefit of the exercise, but this is here to ensure that we are creating a level playing field. And as Pascal has said, this is done through a consensual process involving all the members that sit at equal right at the table, all 94 and increasing, in discussing the terms of reference, approving the terms of reference, and then operating the peer review. And that is really here to ensure that everybody has a level playing field as we move forward into the implementation. Then the question next is, of course, like, yes, we have those terms of reference and have the methodology, but have we actually started with the peer review? And again, you see here that on action 5, we have started. On regimes, we've done a lot of work predating even BEPS, so there's a long precedent, a history of working on the regime work. And in January 2017, we also started the transparency peer review. This is where we're peer reviewing the mandatory spontaneous exchange of certain rulings. I'm going to talk about this in a minute. On action 6, you'll hear this is mainly the MLI, and so that will come later. On action 13, we started the peer review in February of this year, and in action 14, we started in December. So this is a snapshot of where we are on the peer review, on the implementation of the minimum standards. And now, just a couple of words on where we are with respect to each of those. So let's start with action 5. On action 5, that is a review of two aspects, and that's important. On the one hand, we have the regime work. On the other hand, we have the transparency work. The transparency work goes to the exchange of rulings in particular categories with particular countries on the basis of the existing legal framework. So on the preferential tax regime work, we're now reviewing more than 90 regimes from 46 jurisdictions. That's currently under review. That is a dynamic process, so that number may increase as they're being identified and reviewed. Here we have started, and some of this was already in the 2015 report, we have started with the IP regimes, the one on intellectual property, often referred to as the patent boxes, but not just patent boxes, and we do see a lot of movement already here. So you see here that over 10 regimes have already been either abolished or made consistent with the modified nexus approach. So we see a very positive dynamic, so that BEPS is already translating into action, into impact today. On the transparency, as you see here, already by year end of 2016, we had over 6,000 exchanges of rulings, and that number is increasing rapidly as we have moved into 2017. And the peer review is ongoing with respect to 44 jurisdictions, OECD and G20. That's the first step. In a second step, we will be including all of the other jurisdictions. In all of those aspects, we have included extra time for developing countries to recognize their particular circumstances. I'm going to jump action 6, as I said. I'm going to move to action 13. That's country by country reporting. The minimum standard is the CBC, not the local and the master file, but the CBC. And so if we're looking at the domestic framework, over 45 jurisdictions already have primary, secondary legislation in place, and that is also a number that is growing. We have an EU directive that was already approved in 2016 that translates that into European law. We have a fast expanding exchange network with 57 signatories of the Multilateral Competent Authority Agreement, with more to come, and also, of course, countries activating at a bilateral level. That does not have to be at a multilateral, even if it's a more efficient way to do it. We're looking towards activations of bilateral relationships shortly, and we're planning on doing those, I think, towards the end of March and April, so that will be coming soon. We are issuing guidance. That's the last point on this slide, very important. We have already issued guidance in June and December. More guidance is to come. We are in contact with business and advisory firms to make sure that it is fully understood what we're doing here. And if you do have questions, please approach us with requests for guidance. We will look into those. Then moving to the last one, this is action 14 and accelerating just a little. We have here the status and, in some sense, the first results. This is very important. This is the schedule of the peer review on the mutual agreement procedure. You see here that the first batch started in December. We're now in the second batch, March, and we will be moving into the third batch, and you see the countries here. Very important. That means for the next batch, input is invited from business and stakeholders by June. I'm going to come to this in a moment here. So look at the schedule. The schedule is on our website. It is a process that will deliver its first results in July, August 2017. So that's the first batch. So if you look back to the previous slide, you'll see the countries in the first batch. It's ongoing peer input, and also importantly, there's ongoing taxpayer input. And we spelled out what is contained in paragraph 17 of the methodology in a sentence here. It's invited from taxpayers and associations, specifically on access, because there they have more visibility than governments, on the clarity of guidance, you understand whether it's clear, whether it's out there or not, and on timely implementation of MAP agreements. Specifically on those aspects where it is business, where it is taxpayers, and also where it's associations that have the better visibility in there. So please, by all means, do use that, as it says here, use it or lose it. Use that opportunity. That's why we've built it. We've discussed it for many, many months. This is not a whitewash process. It's very important. We even in the team have a mix of people from the private sector and governments to make sure that we come to balanced and correct results. So I'm just stressing this one as the last point, and I think Pascal is coming in briefly.
Very briefly, in case some of you wouldn't have understood what Achim has just said. Taxpayers' input is called on for this review process. We have read here and there, a couple of times at least, some practitioners saying, oh, all this is set for failure. It's not going to work. We are not going to input. This is pretty serious. It's been decades, years for sure, that we've been hearing people complaining about the inefficiency of mutual agreement procedure, and they were right. We have now a minimum standard. Is it the best minimum standard we could have? The answer is no. However, what matters is the behavioral impact we are going to have on tax administration. The fact that you are going to have reports to the G20 finance ministers, to the G20 leaders, and more broadly to the general audience is making a difference. We know it is happening given all the requests for assistance we're receiving from tax administrations. But this cannot happen if taxpayers, which are suffering from poor handling of mutual agreement procedures, don't let us know. We need to know. And we have a very safe and sound process for you to input, either directly, if you feel like that, or through any form of organization which will one way or another make your name disappear, so that it's the organization which will send this. What we cannot take is purely anonymous input, but there are ways for a taxpayer to get the view reflected without disclosing the name of the taxpayer. This is not set for failure. This is set for success, unless some with either vested interest or no interest at all try to convince people not to input in that process. But then don't complain. So please, play with us. Make sure that your views are reflected so that we can do the proper peer review process. So that's a message I wanted to reinforce, again, in case you didn't get Achim's message loud and clear. But we'll now move to the multilateral instrument, which is some form of BEPS implementation. Gita Rotari will explain that.
Thank you, Pascal. And so here we're talking about the multilateral instrument, which is the multilateral convention, which will implement the BEPS tax treaty-related measures. As Achim said, this is particularly important for Action 6, but also relates to measures under Action 5, Action 7, and Action 14. So with respect to the MLI, we recently held a speed matching event at the end of February, beginning of March. This was essentially to allow different countries to discuss their position under the MLI, their lists of reservations and notifications. We had 55 delegations participating in that event, with more than 300 meetings taking place between pairs of jurisdictions. So that will hopefully be helpful in preparing countries for signature. And in this respect, countries are well on track for the signature, which will take place on the 7th of June. They're currently working to finalize their reservations and notifications. The Secretariat is working hard with the countries by providing workshops on the MLI and bilateral assistance to countries where necessary. Currently, we see that more than 25 jurisdictions intend to opt in for Part 6 of the MLI, which relates to mandatory binding MAP arbitration. And the signing ceremony, as I mentioned, takes place on the 7th of June. That's going to be a signing ceremony at ministerial level or equivalent, which will take place here at the OECD in Paris. And countries on that day need to provide their position under the MLI, meaning their reservations and notifications, as well as a document authorizing the person to sign the convention. So all of that's on track. We hope to see as many countries as possible signing on the 7th of June, which is what will help to ensure that the MLI is a success. And passing on now to Jeff, who will talk about transfer pricing.
Thank you, Geeta. Thank you, Geeta. Just a few words about our transfer pricing work, which we have been very busy on. It's not yet ready for public consumption and the latest results of our work, but we are working very hard on some of the follow-up work streams from both Actions 8 to 10 of the BEPS project on transfer pricing, as well as Action 7 on permanent establishments. This is all being done through Working Party 6 in the inclusive framework format, so that all of the 94 inclusive framework members that Pascal mentioned are able to participate in this standard-setting work on an equal footing. First of all, on attribution of profits to permanent establishments, this is follow-up in relation to Action 7, which redefined permanent establishment in certain ways for purposes of the Model Tax Convention. We had a discussion draft last summer. We had a consultation on that last fall, and we have been doing follow-up work to incorporate and take account of the feedback we received in the consultation and to reach consensus within Working Party 6 on the main issues. Most importantly, we want to make sure that the guidance clarifies that double taxation of the same profits will not arise in source countries as a result of the interplay of the permanent establishment attribution process under Article 7 of the Model Tax Convention and the transfer pricing analysis under Article 9 in a case where the permanent establishment is created due to the activities of an associated enterprise in the source country. It's a complex and peculiar international tax issue, which has always been a bit difficult to deal with. The OECD did a lot of work between 2000 and 2010 to produce a report on attribution of profits to PEs, and that needs to be taken into account in this process as well. We also are aiming to provide guidance on potential administrative approaches that countries can take to minimize the compliance burden for taxpayers and streamline the administrative process to make it easier for both taxpayers and tax administrations when there is a PE. And finally, and most importantly, as I mentioned, when there is this interplay between Article 7 and Article 9, because the Model Tax Convention itself does not provide for sort of rules of precedence about which article applies before the other, we need to clarify how that works or how it can be made to work properly so that source countries and residence countries end up with the appropriate amount of tax base and taxable profits where there is a PE. Another important work stream is revised guidance on the use of the transactional profit split method. This is one of the arm's length approved methods in the transfer pricing guidelines. The Actions 8 to 10 report called for revised guidance on the use of transitional profit splits and called for certain issues to be addressed, including broadly, the guidance needs to help clarify when the use of the transactional profit split is the most appropriate method. In what circumstances is it likely to be the most reliable to reach an arm's length result? And secondly, various issues need to be addressed in the guidance about how to apply the transactional profit split method when it is the most appropriate. And that may include discussion of particular profit splitting factors, the existence of group synergies and how those can be appropriately split between the relevant enterprises within a multinational group. So we are in the process of working through these guidance projects with drafting and revision and consultation and conference calls leading up to hopefully the issuance of revised discussion drafts for the public at our next meeting in June. In addition, Working Party 6 has two other work streams that we're currently working on. One is implementation guidance on the approach to hard-to-value intangibles, which was one of the new additions to the transfer pricing guidelines in the Actions 8 to 10 final report. We are very close to finalizing a draft that will be issued for comments from public stakeholders. And then second, we are working on the transfer pricing of financial transactions. This, as many of you will know, is not about the financial services industry, but rather about financial and funding transactions within multinational groups generally. So the work has been going on the drafting of this through the second part of 2016. It will continue through at least the first half of 2017, and again, we are aiming to issue a public discussion draft on financial transactions by this summer. Finally, I thought it's worth mentioning that there will be the issuance of a consolidated version of the OECD transfer pricing guidelines, which will be the 2017 edition of the transfer pricing guidelines, which will incorporate the changes to the guidelines that were approved in the final report on Actions 8 to 10. A couple of pieces remain to be done. One is the Chapter 9, conforming changes to the Chapter 9, which is on business restructurings. That has been agreed by Working Party 6 and is expected to go to the OECD Council for approval very soon. And in addition, we've made a change in the Council recommendation related to the transfer pricing guidelines to facilitate future changes to the transfer pricing guidelines by the Committee on Fiscal Affairs without the need to go back to the Council every time. So I will stop there and pass the clicker back to Pascal.
Thank you. Quickly, on tax transparency, we wanted to update you on the list which has been asked by the G20 and are referred to in the opening. For those of you who have not paid attention to this yet, I think it's worth doing. There were 3 criteria already agreed by the G20. This was in Hangzhou at the G20 summit in September 2016. And the 3 criteria are: have you signed the Multilateral Convention? Have you committed to automatic exchange of information? And finally, is your rating at in the Global Forum good enough, meaning it should be at least largely compliant? And if a country doesn't meet 2 of these 3 criteria, then it has a problem and would be listed. And there is an exception to that, which is if you're non-compliant with the Global Forum, then you are listed whatsoever, whether you've also committed to automatic exchange of information and you've signed the multilateral instrument. And in order to bring to the G20 the updated information and to give a chance to countries to change on time, not to be on the list in July 2017, we've organized with the Global Forum a special process that we've called the fast track procedure, where countries' changes will be examined by the peer review group in June, and the cutoff date for examining the legislation will be end of April, meaning that countries had more time to change with this very fast-track procedure, and if they have improved their legislation, this peer review group and thus the Global Forum in its plenary will be able to say, well, this country actually is no longer non-compliant, but at least partially compliant or largely compliant. And the countries which would have benefited from this fast-track procedure, which is in-depth but a bit quick, will have to be reviewed on the overall implementation of exchange of information on request with the new standard of beneficial ownership as defined by the FATF, which is very stringent. They will be the first to be examined in the new phase of review starting in the fall. All that to say that in July we'll have a list, and we hope and we're confident that this list will be very minimal. Now, a number of observers will say, again, there is a list, nobody on the list, and it's meaningless. And I think it's going to be right, because if we have nobody on the list, it's because countries will have committed to automatic exchange of information when, before talking about the list, they refused to do so. Panama, Lebanon, I think, are good examples. A number of them just refused to sign the Multilateral Convention. And because of the perspective of the list, they have done so. And this is not just a signature somewhere. It's a very significant change because it creates obligation to exchange information on request with more than 110 partners and soon 120 partners. So the fact that we would have as few countries as possible on the list, I think will be meaningful of the fact that countries have changed, are implementing these standards. Finally, this will be a dynamic process. And next to be looked at is whether countries are properly implementing automatic exchange of information. Will they meet their commitment to the common reporting standard? Work is being done, and Achim will tell us a few words about that.
I will indeed, and I will show you a picture to help illustrate this. So the first point here is the deadlines of automatic exchange, which are commitments to either 2017 or 2018 as part of the Global Forum process. Where are we? There's two components to this. There's a domestic implementation part, domestic legislation, aspects, reporting that needs to be put in place. And then there's an international dimension, and so one can break this apart. So if you look at those that are the so-called early adopters, the first ones going into 17 domestic implementation looks on track. That's why you see the check mark. Into 18 domestic reporting laws to be put in place ASAP, where that's not already done. And on numerous occasions it is already done. So there you have that, and then you move to the international implementation where a lot of it is happening. One, there is a large number, 108 signatories to the Multilateral Convention, and more to come. There is increasing use of the Multilateral Competent Authority Agreement that sits on Article 6 of that convention, 87 and more to come, and others might do it on a bilateral one. And then activated exchange relationships, 1,400 plus and counting. And that is the number of individual exchange relationships that we have so far created. So it is a vast and expanding network of bilateral exchange relationships within that framework, within the international dimension. The second point here is the yin and yang of exchange of information. Confidentiality is key. There is no exchange in the absence of confidentiality of sensitive information. There's already almost 100 jurisdictions that have been assessed by a team of expert assessors, and where gaps are identified, assistance is provided to that particular country. And then moving to the last aspect of that brief update is the peer review aspect. There will be a peer review. There is a peer review, in fact, already of the implementation and the correct implementation of the automatic exchange, the common reporting standard. It's a staged approach. It's first initially looking at Risks such as the confidentiality standard, I've mentioned it, domestic reporting legislation at a high level, including low-risk account, financial reporting in financial institutions, but also the dimension of the network and whether the coverage of the network is appropriate and correct. And the methodology and terms of reference going forward are currently under development. So with that, I move to the last part, because all of that is good, but you also need the technical infrastructure to be able to exchange the information. And so there we are in the process, the OECD together with the Global Forum, or the Forum on Tax Administration here, of setting up and putting in place a standardized and secure transmission system for bilateral exchanges between the countries. It's going to be used for the CRS, for the automatic exchange of financial account information, for country-by-country reporting, Action 13, also for rulings, BEPS Action 5. This is work that's been ongoing for a while. It's now moving from the build to the testing stage, and it's scheduled to be ready in time for the first exchanges in September 2017, which is the timeline of the first movers, the 217 countries in the CRS context. And it's open to all Global Forum and all Inclusive Framework members. So with that, I give it over to Pascal.
And I give it over to Georgia, who will brief us on tax certainty work.
Thank you very much, Pascal and Achim. So in the December edition of our tax talk, we told you how the OECD, together with the IMF, has been requested to work on tax certainty. So since December, we have produced a report that we have delivered to the G20 finance minister a couple of weeks ago. And in their communiqué, the G20 finance ministers encouraged jurisdiction to consider the measures we have analyzed in our report, with a particular focus on dispute prevention and dispute resolution. Our report is available online, and you can find it at the link that you see at the bottom of the slide. A very important input for our report was the OECD Business Survey on Taxation, and we have used this survey together with a survey on tax administration to build the analysis and the recommendations of our report. The survey was open between October and December 2016, was very successful. We received more than 700 completed responses, and here we really would like to thank all of you who took the time to complete our survey. Respondents were working for firms with global headquarters in 62 different countries, regional headquarters in over 100 jurisdictions, and the turnover covered in our survey amounted to over 17 trillion US dollars. This amounts more or less to 99% of the turnover covered in the FT Global 500 dataset. Half of the respondents worked for multinational firms, and about 2/3 were tax directors or senior tax managers in the firm. We don't have time today to take you through the results of the survey in detail. The same is for the survey on tax administration, but you can find all the details in our report. And here I would like to take you through the top 10 sources of tax uncertainty for business. You see then within the top 10 sources of tax uncertainty, the first two refer to tax administration. This is bureaucracy to comply with the legislation and unpredictable or inconsistent treatment by the tax authority. The next most important factor relates to the international dimension of the tax system and its inconsistency or conflicts between tax authorities on the interpretation of international tax standards. Then we move to dispute resolution, and we find lengthy decision-making of the courts or of the tribunal. And then we move to the legal system, so to the legislation, where business seems to indicate that complexity is a major driver of tax uncertainty. In the report, we propose various solutions which are very practical, very concrete. I don't have time to go through all of them today, clearly, but I would like to focus your attention on some innovative solutions we have discussed in the report. These are, for example, multilateral advanced pricing agreements. These are pricing agreements where more than one jurisdiction get together to look at their agreement. When we ask in our business survey whether this could be a useful tool to resolve uncertainty, 44% of multinationals respond very positively, saying that this could be a very important or an extremely important tool to enhance certainty. We also proposed multilateral audits, and there about a quarter of the respondents to the survey find this tool, again, very potentially very effective in increasing certainty. And then we discussed multilateral cooperative compliance programs. And there about just over 1/3 of our respondents who work in multinational find this tool, again, extremely important or very important in increasing certainty. I will stop here. I'll pass it to Pascal, who will discuss our current and future work in tax certainty.
Me again, and apologies for that. Just a few quick words on what's next, because it's good to produce a report, but here in the team, we like, making changes rather than reports. So there will be a follow-up, drawing on all this good work. And the follow-up is about improving the dispute resolution, but even more importantly, and instead of dispute resolution, we use dispute prevention here. And I would like to mention the work of the Forum on Tax Administration that most of you know about, gathering all the tax commissioners of OECD and G20 countries. They will have a plenary at the end of September this year, and I can tell you that this topic is very high on their agenda. And we are working with them to see how we can promote APAs, how we can promote joint or simultaneous audits, which could give more certainty to taxpayers, even though they may not like that much simultaneous audits, but that could be a way to better coordinate tax administrations and limit the discrepancies there. We are also trying to work on a multilateral cooperative compliance approach, which could relaunch the interest of tax administrations to the cooperative compliance and make it broader. We may have some experiment anytime soon to work on that. So dispute prevention, cooperative compliance is one very important work stream. The second one is very well known. That's action 14 of the BEPS action plan, improving mutual agreement procedures. The reviews, I think, will be the generator of behavioral changes, but then we need to work on these behavioral changes by providing technical assistance and by making sure that cases move faster. The MLI, the multilateral instrument, being a good instrument to promote arbitration. More than 25 countries will probably adopt arbitration, and we hope that more will be joining. And finally, all this will be reflected in the annual report we will now be doing on the tax certainty work to the G20. So there is a plan. We did the report, we did the survey. Maybe at some point the survey could be done again, and thank you for the very high level of participation to the survey, so that we can see whether there is some impact and some changes. So that was for the work on tax certainty, and we'll conclude that webcast with a very important, sensitive and sensible work on VAT that Pete Battu, our specialist, will present to you.
Thank you very much, Pascal. Even those of you who are not immediately familiar with our work on VAT will be aware of the fact that we completed the OECD VAT GST guidelines at the end of 2015. These guidelines they comprise a set of standards for the application of VAT to international transactions, focusing primarily on trade in services and intangibles. Now, following their completion, the guidelines have now also, in the course of last year, been adopted by the OECD Council as a so-called OECD recommendation. Now, this is a pretty major thing, because this is actually the only first OECD Act or legal instrument in the area of VAT and GST. A legal instrument, what does that mean? It does not mean that the instrument is legally binding, but it represents a very strong political consensus, which is quite important for us. Also very important is that the instrument is now open to adherence by non-member countries, which provides non-member countries the possibility to join the instrument and to broaden the consensus, so to join the political consensus. Now, the new recommendation, so the VAT GST recommendation, will be released at the Global Forum on VAT in Paris on 12 to 14 April. We will again have a very broad representation of countries from around the world. Actually, we just registered our 100th delegation today. And they will not only discuss the guidelines, they will also discuss a range of issues, including the digital economy, the digitalization of administration, and of course issues around VAT fraud. Okay, I jumped one slide there. Another important evolution in this context, as again many of you will recall, the VAT guidelines also include mechanisms for the collection of VAT from non-resident vendors, so from overseas vendors of digital products to private consumers. This had been identified as a major issue, notably in the context of the BEPS work, the BEPS action plan. And actually the BEPS Action 1 report, the final BEPS Action 1 report, included a recommendation for offshore vendors, so overseas sellers of digital products, to register and remit the VAT in the countries where they have final consumers. And the report, the BEPS Action 1 report, proposed a number of implementation mechanisms. Now, this work has sparked what I would call a trend, an implementation trend, whereby countries around the world, a number of which are mentioned on this slide, whereby countries around the world have started to implement or have already completed the implementation of regimes to collect the VAT from foreign sellers. Our focus at this moment is on implementation. We're developing implementation packages, notably on the operation of the regimes to collect VAT from offshore vendors, and that will be one of the key discussion points at the Global Forum on VAT. With that, I hand over back to Pascal.
Thank you. You will be soon done with me. So quickly, what's next? First, the Inclusive Framework plenary will meet in June and will adopt a report on its activity to the G20. So I think that's an important block here that we have for your attention sometime at the end of June, early July for the G20 summit, the annual report of the Inclusive Framework on BEPS. Second, the BEPS peer reviews. You have seen that it has started, in particular for mutual agreement procedure. Do I need to remind you of the fact that your input would be welcome? No, I don't think I need to do it. Global Forum fast track process, and for those of you in the financial industry also, what are the possible consequences on countries being listed or not? Most of the information is already available, so you can have a sense of who's at risk or not. The first automatic exchange of information under the Common Reporting Standard will start very soon, something to be monitored. And finally, certainly not least, the work of the task force on the digital economy will be extremely important, especially if we are to deliver something meaningful for the spring meetings of the IMF and the World Bank, for the G20 meeting at that time in 2018. So this is what's next on our plate, plus all the things which have been mentioned during this webcast, in particular the work on transfer pricing, where we will release documents for public comments, and we expect to have your comments, constructive comments on these. You can see we're still extremely busy and happy to be busy. So we're done with our presentations, and we have a few minutes left for the questions and hopefully answers. We have received some during the webcast, and I will turn to Arim for the first one. The question is about tax evasion and the fact that we may not have an international definition of tax evasion. So have the OECD and OECD countries decided what they would do together, what they would together consider as tax evasion?
And here's the answer. No. I'll give a slightly longer answer. I think, first of all, this is a question not in the BEPS space, but it's a question in the automatic exchange and the financial account and the tax evasion space. BEPS is a tax policy project, so here we're moving to the work that we do on automatic exchange of information. We've had discussions on what countries understand as tax evasion, and there we need to also be careful with the French translation because there can be a mistranslation, but we've had those discussions in the OECD for a number of years, and there's significant overlap between the different definitions of OECD and also more broadly G20 countries where you find commonality. When it comes to specifics, however, this is specific to the cultural identity of different countries that have different legal traditions, common law, civil law, case law decisions. So I think the approach that we have taken largely in the work that we have done on automatic exchange, on information exchange more broadly, including on requests, is to focus on providing the countries with the information that they need to apply their definitions that their parliaments have decided to apply to their residents. And so it's an approach of enabling countries to effectively exercise the sovereignty that their parliaments have voted, rather than necessarily trying to harmonize global definitions that do reflect different judgments, even if we do see some significant overlaps on the general value judgments that would make something evasion, as opposed to what in the English context may be called avoidance.
Thank you, Arim. And yes, be careful with the French. Evasion in French meaning fraud and not avoidance. So let's be careful about that. Second question is about the countries and jurisdictions of relevance. What's the process en cours? What's happening there? Again, I will turn to Arim as most of the minimum standards are with him.
So yes, on this one, first of all, perhaps a word on what is the idea of jurisdiction of relevance before we update you on where we are with that concept. The basic idea is that you should not have an advantage as a country by staying outside the process. What we want to do, for instance, in the area of harmful tax is not displace features that may be happening within the inclusive framework to countries that are outside the inclusive framework, but resolving the problem, not moving it somewhere else, but resolving. And it's that very dynamic that we already used in the context of the work that we do on exchange of information, where the same context exists, where the members can identify a jurisdiction of relevance, and we approach that jurisdiction just to make sure that maybe practices that are harmful, or maybe the CBC requirements, don't just move to other countries that don't participate, but don't allow us to get the benefit for all of those in the inclusive framework that we all have if we all move together. So that's the concept in terms of the process. We have discussions in the inclusive framework about finding those countries. Those are bottom-up discussions, so we look at the respective minimum standards. Recall that from my presentation, there's in particular the 4 minimum standards. So we look at that, have discussions at the working group, which countries are jurisdictions of relevance with respect to that standard, then bring it up to the inclusive framework, have a decision, and then engage with those countries, of course, with a view of trying to get them into the process rather than in the end identifying them as jurisdictions of relevance. The last point on this, perhaps, this is a dynamic process. The world is changing as the world changes. If we are to identify countries now, we may then in a dynamic process identify others in the future. So it's a member-driven dynamic process.
Thank you, Arim. I would just like to add that as regards Action 6, which is anti-treaty shopping provisions, we are currently dealing with the countries of relevance to make sure that they join the multilateral instrument when it will be signed on the 7th of June. Of course, the peer review process, when it started, and that will come later, will look at those which would not have signed. But all the treaty shopping hubs basically have been targeted by the Secretariat, by the member countries, and we are engaged in informal conversation with them to make sure that they join. And if they don't join, they face the risk to be identified as countries of relevance. And we're confident so far that most, if not all, the treaty shopping hubs will be signing the multilateral instrument. We have a couple of questions for Jeff. I will start with a question question on non-CIV funds. What's happening there? You may remember that this issue of Action 6 and the issue of treaty shopping and how we fix it raised some concerns from the industry. We did provide a solution for CIV funds, but there were questions remaining from non-CIV funds. Jeff, any idea of where we stand on this?
Yes, we we had a discussion of the non-CIV funds and how the principal purposes test in the model treaty may apply to those funds. It's a difficult question because it's not simple. There are many different flavors and varieties of non-CIV funds, and trying to craft a one-size-fits-all solution or discussion and guidance is not easy to do. We had a consultation, a discussion draft over December, January, took into account comments received, and Working Party 1 had a discussion of this in late February. So the 2017 update of the Model Tax Convention and commentary will include some examples of non-CIV funds and the application or non-application of the principal purposes test in those examples. It's important to remember, and this is explicitly stated or will be in the commentary, that these are only examples. They're not establishing any conditions or requirements for non-CIV funds. We continue to be open to discuss further guidance. We are looking forward to hearing any constructive suggestions. We also internally are thinking of the so-called TRACE project, which would enable funds to get documentation on the treaty entitlements of their investors, and that could be a practical solution that would effectively eliminate risk of an anti-abuse rule applying to a non-CIV fund. So please continue to talk to us. We're very open to further discussions on this.
Thank you, Jeff. Actually, most of the questions related to this issue of non-CIV funds, pre-existed the BEPS project, and I'm not sure the BEPS project has had any impact or additional impact on the industry. But the questions have been here. They are very important, very difficult, and we are very much looking forward to engaging with the industry to make our delegates and all the countries engaged to try to find the appropriate solution for this very important industry which can fund the growth and the economy. So very, very important topic. Another question on another industry, which is the reinsurance industry, not necessarily captive reinsurance, but the reinsurance companies. What are we doing there? Are they hit or impacted by BEPS? What's next in this area? Jeff.
Thanks, Pascal. A couple of the BEPS final reports refer to upcoming guidance, which will include within its scope transactions involving captive insurance, and that is our transfer pricing guidance on financial transactions. And as I said earlier in the webcast, we are in the process of working on that guidance. The focus there in transfer pricing generally, and specifically in financial transactions and captive insurance transactions, is to first accurately delineate the transaction to make sure that the tax administration has a correct and accurate understanding of what's going on. In the captive insurance area, as in non-CIV funds, which I was just mentioning a minute ago, there are different variations. So accurate delineation is very important because not all captive insurance arrangements or reinsurance arrangements are alike. So the transfer pricing guidance obviously is focused on getting the pricing correct. It's not about denying deductions for premiums paid or recharacterizing transactions unless that's called for as a result of the accurate delineation process. So we will be including captive insurance in the financial transactions guidance, but I don't think the industry, should be worried that we are viewing all captive insurance as tax avoidance. That's certainly not the case. We understand that captive insurance can be used for valid business purposes and is done so in many cases. Regulation also is a relevant factor, and we will be taking all the relevant facts into account in our guidance.
Thank you, Jeff. We are 1 minute far from the end of this webcast. I will take the last question we received, the latest question which we received on the financial transaction tax, the FTT. The question is, we heard that Minister Schäuble, the finance minister of Germany, mentioned that this was raised in the G20 meeting. What's happening? Well, I can tell you that the OECD is not going to undertake any work in this area. What happened in Baden-Baden at the finance ministers' meeting was indeed that there was a point of information on where things stand. You will remember that in 2009 a report was asked from the IMF, which produced a report on a possible FTT, and there was no appetite at the global level to pursue. However, at the EU level or within the European Union, a group of countries, I think 10 countries in enhanced cooperation, decided to work on this. So this was reported to the G20, and there is no work to be done at the G20, as obviously there is no consensus on such a thing. So for those of you who would be worried that there would be a new work stream on tax on this in the G20 or at the OECD, you can be reassured we have enough on our plate to do other things, and all this is between 10 EU countries working together on this. Well, I think we have come to the end of this webcast, these new tax talks. I hope they were useful to you. Your feedback is very much welcome to make sure that you have the feeling this is useful to you and that brings good information. We were very happy to participate on our end, and we will get back to you definitely before the summer for a new update. Thanks for the team to have prepared these, to have participated, and thanks to you all to have been patient enough to bear with us for this hour. Thank you very much.